Candid conversations on the biggest news stories, legal issues, and policy developments shaping the crypto world every Friday at 12:30 p.m. Eastern. Well, it's another stacked show. Hey guys, what's up?
Happy Friday.
Happy Friday. Sorry, Ellie. I cut you off there. I was excited to talk.
No, it's cool. I was going to say, just to get us started, we do have another busy show. We got 3 awesome guests to bring to you guys today with Blockchain CEO, Association CEO Summer Mersinger, Head of Policy and General Counsel at venture capital giant a16Z, Miles Jennings, and Gabe Dinari. Am I saying that right, Jacqueline?
I think so.
Yes.
We will find out today when we bring him on.
Yeah. Gabe Dinari, the
we'll get
co-founder
a name confirmation. Yeah.
and CEO of Dinari, a tokenization platform. But first, as always, the headlines. The New York Stock Exchange made waves on Monday when it announced plans to launch a trading venue for trading and settling tokenized stocks entirely on chain. And this is really notable. I mean, I think the internet pretty much blew up when the NYSE put out this press release on Monday. It's just another example, I think, of a traditional exchange taking another massive step into crypto. We had Carlos Domingo, the CEO of Securitize, on the podcast with us this week. He gave us his reaction to the news.
I saw the announcement as extremely positive. A lot of people were criticizing it or were skeptical about it. I think that first, New York Stock Exchange is the New York Stock Exchange. The fact that they are launching a new trading venue, I don't think it's going to be an exchange. I think it's an ATS, which is technically not an exchange. But the fact that they're launching a new venue that is going to have native tokenized equities, not derivatives, not wrappers, not price trackers, but a token that actually represents the same security, which people don't realize how important it is to do it in the right way, because then, people know what they're buying. You can hedge it with a, actual security that trades in traditional markets, etc. But that this is going to sit outside. It's not going to go through the same market structure. It's not going to use DTC. It's going to allow for a new trading venue to emerge. I think this is hugely important, and kudos to Michael and the team at the ICE and the New York Stock Exchange, because I think it's very forward thinking what they're trying to do, as opposed to maybe other players doing some more conservative stuff within the same kind of market structure without trying to rattle the boat too much.
Yeah. I think, Gerald, you asked him about the concern over what this means for DeFi, right? Tokenization in DeFi, as opposed to a big public exchange coming in and kind of stealing the show, right? He didn't seem too concerned, if I remember correctly.
Yeah, I think it's interesting, like digging into it. My reaction to that announcement is kind of like, cool, ? Maybe. It's interesting. The difference, so for DeFi, and particularly around tokenized equities and some of the products that they're launching, volume is always like challenging, right? You're talking about volume of liquidity on like a $3 trillion industry versus the volume that an exchange like NYSE can bring, and it's 20 trillion or whatever it is, volume of liquidity. And so the reason I say like cool ? And some of the things we talked through with Carlos is, what does this mean? Like, nobody really knows what chains NYSE is going to use to settle. What does this mean?
I actually have some daylight on that. I asked John D'Agostino at an event I saw him at earlier this week, and he said they're actually building their own.
Yeah. Okay. So cool ? Like,
yeah.
It's
I'm with you, Gerald. Yeah.
The challenge with this sort of phase of tokenization, and I am excited to get into it with our guests later, is, are we in this like DLT phase, right, where it's just distributed ledger technology and we're talking about like permission gardens, or are there actually going to be permissionless chains involved in this kind of trading, because this brings up like privacy and like illicit finance requirements, like accredited investor verification. There's all these things that need to be built on chain for this stuff to work at the scale that New York Stock Exchange wants them to work at. So we'll see is kind of my reaction so far.
Yeah, I agree. I think also the part that Carlos was talking about, and the fact that it's like native tokenized securities, is what makes it valuable. And I think it's also just like a nod to the industry of, I guess, maybe respect, or like, oh, we see this as legitimate if the New York Stock Exchange is doing this, right? So like, Gerald, your comment of like ? I agree, but I think it's like, okay, it's a good thing that something or a company or entity of that size is getting involved at the very least. So a lot of TBD, but.
Well, staying with NYSE, let's get to the other big story of the week down there. Crypto custody and infrastructure firm BitGo held its IPO there yesterday, where it went public at $18 per share. And that values the company at $2 billion, slightly on the lower end of what we've seen of some of the other crypto companies coming to market last year. And BitGo is one of the first crypto infrastructure providers to come to market. It's also tokenizing its stocks through a partnership with Ondo, so its investors can get access to those tokenized shares on Ethereum, Solana, and BNB as well. So kind of staying true to that crypto native form, as it were. And yeah, good for BitGo. I mean, I think a lot of excitement down there around that. I love when companies come to market at the NYSE. I'm a little partial because I did work down there for about 18 months right before COVID. And I just feel like going public on the New York Stock Exchange is a little more ceremonial than the NASDAQ. I like the NASDAQ too, but I just feel like the NYSE is like really where it's at. But that's just me.
Yeah, no, it's exciting. So full disclosure, Say Labs is a BitGo client. So congrats to our service provider on that front. I think it's also just the willingness, we've talked a lot about disclosures. We talked to Carlos about public market disclosures. We talked about them in the context of DATs. And so having a custodian at the scale of BitGo go public and going through all those really onerous sort of SEC filings and the method of going public, which is very onerous and brings a lot of new compliance and reporting onto a company. It's exciting to see like a big custodian like BitGo sort of go through that process. And it frankly like gives me a little bit of confidence just in like the back end where so much of crypto lives, right? Is that we're ready for kind of the main stage, as you mentioned, New York Stock Exchange, definitely the main stage as far as like going public goes. So excited to see that part of the industry, continue to kind of grow up in some sense, which is great.
It'll also be interesting to see how many other IPOs we see and like on what cadence, because it's already the end of January. This is the first IPO for a crypto company of this year. It's still impressive and exciting nonetheless, because, the IPO season was kind of dry before 2025. And so it'll be interesting to see like how much of this actually rolls out over the next 11 months or so.
Yeah, for sure. I think we're expecting Grayscale, potentially Kraken at some point. That'll be a big one. Obviously, that'll be sort of like the last US exchange, or maybe crypto.com, but they haven't actually announced intentions to go public yet. But Kraken will be a big one. Is there anyone else we're missing?
Not yet. Not unless you have a scoop for us today. But
Yeah,
Working on it.
Yeah.
But I do also, I just quickly, I don't want to overlook the Ondo aspect of this. Making your shares tokenized through Ondo means that those shares can also potentially be like leveraged and traded in DeFi and kind of abstracted away from like the actual redeemable sort of share of stock. And so it's going to be really interesting to see how that impacts like the trading volume and the like price volatility of stocks that decide to tokenize that way, because we really don't know what happens when DeFi is sort of really publicly trading stocks. So I'm curious to see how that goes for them from like a market perspective too.
Is this the first time anyone's doing this with publicly traded shares of a crypto company, Gerald? Do you know?
I know Galaxy's shares are tokenized.
Right.
Solana, yeah.
And yeah, but this is, I think, one of the first where the issuance is happening, because I know Ondo has traditional companies that have been public for longer, that have been sort of tokenized, but this may be just the second case where they actually launched and tokenized like at the same time. Yeah.
All right. Well, staying with markets, let's talk about those, because I know we don't really. We're not really a market heavy show, but
not financial advice.
Really, yeah, exactly. There you go. Not financial advice, but if you were watching the headlines out of Davos this week, it wasn't really tough to see why equities were sort of on this roller coaster ride. I think we saw the S&P and the NASDAQ. They did wipe out their yearly gains in a day over these tensions, these geopolitical tensions over Greenland. Trump was, going to buy it. Then he wasn't. Then we reached a framework of a deal. And, we were down, we were up, gold hit an all-time high, so did silver. But, the crypto market was seeing losses, seeing gains. I think we're up a little bit today, but for the most part, the week we've been down. The reason I bring this up is because, I think we talked to Carlos, I think, about this on the show too. for a long time, this narrative of Bitcoin is a safe haven, right? This whole week we've been hearing on CNBC, people are rushing to gold as a safe haven, even silver, but Bitcoin doesn't really seem to be acting this way. And Gerald, I know you have thoughts on this. So just curious, is this going to be a theme we see going forward? Is Bitcoin ever really going to act like this safe haven that I think a lot of the maxis have been hoping it would act like?
Yeah, I think the answer is like not yet. Like there's a big part of the narrative that Bitcoin is digital gold that just hasn't played out in the mechanics of Bitcoin yet. And so what you need for an asset to actually be a source of safe haven and volatility is obviously like massive market cap. You need global buyers and sellers so that the market doesn't swing on like concentrated bets. And then there's also the question of like whether or not we ever get real global reserves, right? If you saw real global reserves happening where you have large institutions, sovereigns holding Bitcoin, then maybe it starts to behave a little bit more as a safe haven. But for right now, it's basically acting like a tech stock, right? Like when people go into sort of these volatile environments, they're looking for risk off assets that are either going to move in the right direction or are not going to move much at all. And Bitcoin to date like does not do either of those things. It's primarily gone up in price. Again, like not financial advice. I'm not a financial advisor. It's primarily gone up in price in risk off like very low interest rate environments, right? You look at the last 20 years, Bitcoin's entire existence is post financial crisis. And so you would have to see much heavier adoption. It does have the fixed supply. It does have a lot of dynamics that you would hope would sort of lessen the volatility, but we're just not there with like the market dynamics yet. People are still trading it on leverage. They're still speculating a lot on futures, which always creates kind of volatility and liquidations, right? We had 1010 as a huge liquidation event. And I think like it's not that it won't happen. It's just that I think the way it works right now, we're not there.
We're still early.
Yeah, we're still early. 20 years later or 15 years later or whatever it is. Yeah, we're still early. Yeah.
Okay, well, let's get to our policy part of the headlines, and that's newly minted CFTC Chair Mike Selig is already making strides in his new role. This week, he launched the Future Proof Initiative, where the CFTC is going to actively start reviewing its existing rules and regulations and start to modernize them to fit regulatory purpose. So basically, kind of tailor making these regulations to fit around these new rules and regs for cryptocurrency, for prediction markets. Last week, he also said he would build on some of the initiatives launched by Caroline Pham before she left office. If you guys remember, she launched that CEO advisory committee. Selig said he was going to build on that. He actually renamed it and said he would add a couple more CEOs to that council. He said those would be kind of a feature going forward. They would play a big role in this new push over at the CFTC. I think we'll learn a bit more about what Chairman Selig is planning to do in the fireside chat I'm having with him and Chairman Paul Atkins at the SEC next Tuesday. I'm very excited about that. So looking forward to that, but also just, I feel like we are at an inflection point now, especially at the CFTC with new leadership, kind of working hand in hand with Atkins. It kind of reminds me of this time last year when like Atkins came into the role and we were seeing like this brand new push. It's kind of an exciting time to see what the agency is going to start doing, especially in conjunction with market structure.
Yeah, shout out to, so barring Snowmageddon in DC over the weekend, hopefully that will go through. And yeah, Ellie, it's awesome that you're moderating that. I'm excited to be there. I think a lot of folks in the industry are excited for this sort of like unveiling, of the new guard. And obviously you pointed out and we've talked about it on the show before, the working relationship between Chair Atkins and new chair Selig, in their former roles should allow them to like really coordinate well and work together well. You won't have kind of the turf wars that, maybe we've seen in past administrations. And so, yeah, it's just exciting to see what we get out of this new sort of CFTC. And of course, with like the Senate Ag draft dropping, like, there's obviously a lot that the CFTC is going to have to deal with. So exciting times.
Yeah. And by the way, I was informed.
Yeah.
Oh, sorry. Yeah, go ahead.
No, I was going to say, for the conversation that you're moderating, is there anything specific you want to get across or you're trying to really pull out of these two?
Well, I'd love to know where we stand on the innovation exemption from the SEC, because Paul Atkins said that we would be getting news on that this month. So I don't know, maybe an announcement there. We'll see. More to come, hopefully, on what CLIG's plans for this new future-proof initiative at the CFTC will look like. I'm hoping to break some news, Jacqueline, frankly, which is
you better. It's a typical Ellie move to do
what
that.
I like to do. So we'll see. But also, I was
Yeah.
told that if the Snowmageddon does happen and we are all stuck under 2 feet of snow, then it will be moved online. So it's going to happen anyway, which is good. So plan on next Tuesday at 10 a.m. But speaking of the CFTC, we are very lucky to have our first guest is a friend of the show, Blockchain Association CEO, but former CFTC Commissioner Summer Mersinger, who's been hard at work these last few days between the Senate Banking Committee markup drama, parsing through a new bill from Senate Ag, and writing an op-ed for American Banker, all while trying to bat the banks back on yield. Summer, welcome back to the show.
Thanks for having me on, and happy Friday. It's been a long week. A long couple of weeks.
Yeah, this week was a little, I mean, say for you, it was probably a little maybe less hectic than the week before, but maybe not. Maybe it was just as hectic. You tell us.
Yeah, I mean, I think we maybe got a few more hours of sleep this week than we did the week before. It felt like college when you're preparing for your final exams and you wait and study all night to get ready for the next day. That's pretty much what it has felt like, getting through this text and trying to interpret it and get information out to everyone is like we're cramming for finals in college.
Yeah. Well, let's dig into that a little bit. I know because you're assuming talking about the Senate Ag Committee's bill, which we saw come out on Wednesday. We've seen various statements from the trades, including Blockchain Association, saying that you guys are parsing through it. But from at least what I've seen, it's mainly been relatively positive reactions so far. I think there was maybe 1 or 2 newer sections. But what are your thoughts so far on the text as a whole? And are you concerned that we could be looking at perhaps a partisan markup going into next Tuesday's event?
The Senate Agriculture Bill to me was a much easier read, just because for me it was so familiar. This is the statute I know. This is what I understand, and so it was pretty straightforward. I thought it was well done. No major concerns at this time. Certainly, I haven't heard any from our members either. So I think that bill's in a good place. But to your point, it's partisan right now. I don't know how much buy-in they have from their Democrat counterparts. I assume they're going to go into a partisan markup on Tuesdays, assuming we're not all snowed in and the senators aren't snowed in their home states and can't get back. But and that's really unusual coming out of the Senate Agriculture Committee. They really try to do everything in that committee on a bipartisan manner. So this is going to be a bit of an anomaly, coming out with a partisan markup on this text. I don't think there's enough time to try to get enough Democrat proposals back in there to have it be a bipartisan markup. So I think we are looking at a partisan markup on Tuesday coming out of Senate Agriculture. And, the question is, what happens next? I think the other piece is it's not that far off from Clarity. There's a lot of similarity there, and Clarity passed on a bipartisan bipartisan vote in the House. So I don't think it's a lost cause that it might be a partisan markup. I still think there are opportunities to pick up bipartisan support, getting Democrat support moving forward. But for this initial step, it'll be just probably coming out of committee on Republican only votes.
Summer, maybe if I can ask, what kind of happened with the Dems? Like, what was going on in the room, or what's something that maybe didn't make the headlines?
Yeah, I think there was a little bit of, some of the back and forth on, things around DeFi. I still think some of the issues there have more to do with a education gap than they do a true policy position. I think that there are a lot of members on the Democrat side who are in this, in their mind, we've got to do something around illicit finance, but they're not understanding what we're talking about when we're talking about DeFi. So that's I think, a big piece of why this didn't, go forward. We didn't hear as much about ethics on the agriculture side. I think they, I'm sure it was coming up in conversation, but I think it was less of a hard line in the sand. And I think they're really just kind of still struggling with understanding, okay, what does it mean for DeFi to be in, to operate in markets that normally have intermediaries that we can regulate? It's a whole new system. It's a new technology that they just are still trying to fundamentally understand. And so I think that's probably the real reason that they couldn't quite get there with the Agriculture Committee. Is they just need a little more time to fully understand what we're talking about when we're referring to DeFi protocol.
Yeah, Summer, I want to ask a little bit more about your experience with how the sausage is actually made here, right? Like it's we're always, I feel like, at the final stretches, but also some of the things that have come up recently in conversations we've been having is one is whether you're talking about Coinbase and Brian Armstrong taking that position, or sort of the back and forth, the war of the comment letters. I think we've discussed on the show before, with the ABA coming in after Genius has passed and making a lot of public statements. There's this idea of like the industry sort of negotiating in public with Congress. And I'm wondering, one is, do you think that has any merit or is effective? How is that impacting discussions? And then it also seems like at this phase in negotiations, we know that staffers play a very heavy role in kind of earlier drafts. And then at this point, I've heard that, we're much more into the phase of member to member conversations. So in terms of like the home stretch here, how much do you think that sort of negotiating in public narrative or process is valid? And then also, like, are we at that sort of last stretch, like senator calling senator, direct kind of member to member communication here?
Actually think it's healthy to have these kind of open negotiations. I was, on the Hill for more years than I care to. I don't want to age myself, but there was certainly a lot of backdoor dealing when I first started on Capitol Hill. Nothing was really out in the public. You had no idea what were in these bills a lot of times by the time they got to this floor, and you just had to kind of swallow it and hope for the best. So I think it's a healthy development that we have public forums now where people are interested. I think it's great that we have voters and people who want to participate and want to know what's going on and care. I mean, for I don't know how long I remember where nobody cared. They'd care about some specific issue. If you couldn't get your local news on your cable channel or whatever it was, but for the most part, they did not care about making laws which impact everyone. So I think it's a really good development that the public has this interest in and is following it. Where it gets tricky is if the rhetoric gets less constructive and more kind of personal attacks, which I think this has been a good a good discussion. I don't think there have been a lot of personal attacks. I maybe have attacked the banks a little bit, but I think it's fair game in the lobbying world. We that's the way it works in Washington. But I think it's good that we have these discussions that are public so that everybody can understand what's going on. I think it helps the process, and sometimes it is made to sound more dramatic than it really is, especially like the Coinbase issue. Coinbase has put a ton of work into getting market structure done over a lot of years. And so I hate to see where they're getting somehow blamed for the whole thing blowing up. I think they were making a point. There were still issues that need to be worked out in the bill. They're not alone in some of these issues. Yield is one of them, where they're not on an island. There are other interested stakeholders who are trying to negotiate in good faith and get to a place where we can get some agreement. And it just kind of probably got hyped as more dramatic than it was. But again, I think this is all healthy part of legislating of how the sausage is made. And now it's much more transparent than it used to be, which I think it's good for the citizens, good for the average American.
Do you think this needed to happen in the way that it did, though, Summer? I mean, you mentioned your experience on the Hill. I do have the number here, but I won't say it. Before your CFTC career, you did spend a number of years on the Hill. But just from your experience there, like, was this something that needed to happen before the markup, or could these issues have been worked through after a markup? Because you mentioned Coinbase and the yield issue, and then there were obviously like maybe one or two or even maybe three other issues that industry mentioned. Was it paramount that this happened before the markup, or could this have just been worked out, maybe after that, before the bill went to the Senate floor?
I always think it's better to work these things out before the markup, because once you get past that vote out of committee, it does get increasingly more difficult. There's fewer opportunities to get changes when it's going to the floor. I know there are some opportunities because of the unique way they're going to merge these bills and take them to the Senate floor, that maybe there's some more opportunity there. But I've never wanted to be in a situation where the fix is an amendment on the floor. Because there's so many things that can go wrong there. So you're always better off having a good product coming out of a committee markup. I understand staff's point of kind of really being protective of the language and not sharing it broadly until 48 hours before the markup. But that made it really difficult to identify some of those issues that were existing, to really get some analysis on it, and to be able to say like, hey, we need to make some changes here, and this is why. So then, you would have been relying on amendment process in the markup to fix things that, honestly, I think there are a number of issues where staff was not opposed to fixing it. It might have been a definition that wasn't quite clear, a conflicting definition, things that are not necessarily controversial. So, if we'd had the language maybe a little bit longer, maybe, but I still think the big agreements on some of these issues like yield, it wasn't, I don't think anyone would have been really seriously negotiating language if there wasn't that deadline of the markup. So I think the deadline of the markup was good. I think that the kind of pause is good for the overall bill. And I do think it sounded dramatic, it looked dramatic, it felt dramatic, but I really do think like this is a pretty normal part of the process. And I always say that any legislation will completely fall apart before it actually comes together and get passed. And so that's kind of the way I view it, is like everything's going to feel like it's dead and gone. But that's when everybody is serious and they get back to the table and really come up with the appropriate, compromises they need to actually get something done.
Summer, we know that you wrote an op-ed this week for the American Banker on crypto banking. I'm going to pull some of that up here, but while we do, you argue that the real choice isn't whether crypto banking exists, but whether regulators choose to embrace it in a supervised system or not. Critics call the OCC trust charters given to players like Circle and Ripple create risk, but then you argue excluding them is actually riskier. So is this really a stability debate, or is this just a competition debate kind of dressed up as one?
I think it is a competition debate. It's that idea of like, and I think this happens in a lot of industries, the established players want to protect their kind of regulatory moat, right? They have fought and complied with these regulations since, the beginning of time. And the idea of a newcomer coming in always concerns them, because they think, oh, they're going to get a special deal, or they're going to get different treatment. What's frustrating here is I think the fact that even before these applications are being considered by the OCC, the banks were already putting in comments against allowing these charters. I think you are undermining the OCC's ability to do a fulsome review of these applications. There are rules that they have to abide by, and they're going to follow those rules and do a full review of these applications. This isn't like a check the box exercise for these regulators. So I think it was definitely not fair to the regulators themselves to question whether or not they should be allowed to apply or even being considered for these charters. But the other piece of this is, I think anytime you have activities like this where you are moving money and you are dealing, these are real people involved with real money, having federal oversight isn't a bad thing. It's a good thing. It helps bring stability to the system, helps bring some confidence in the system. And so why we would say it's better to leave them out rather than bring them into these, with these charters, I don't understand. Because in my mind, if you're worried about a level playing field, keeping people out and not letting them apply for this charter, that's when the playing field is unlevel. So I really think they're just being a little bit protective in, trying to create a regulatory moat around the businesses that they do by not letting in new entrants, new technology.
Yeah, Summer, in another recent op-ed for CoinDesk earlier, I believe it was earlier this month or in December, you cited an SEC statistic that was pretty surprising, at least to me, that they estimate that the 6 largest domestic financial institutions control assets equivalent to more than 60% of our GDP. That seems like a pretty alarmingly high number and not maybe necessarily representative of this like community banks are going to hurt sort of argument that we hear around stablecoins and yield. How do you think the crypto industry and like stablecoins more broadly fit into that sort of truth as a market dynamic?
Yeah, people like to throw around this idea of systemic risk, stability, but when you look at the numbers, it's so, we're talking about very small percentages in comparison to the larger players in the financial services sector. And so that's a great example at the SEC. I always go back to the CFTC. The largest clearinghouses are actually systemically designated under Dodd-Frank, and they have, they are controlling way more volume of trades and clearing than anyone else, any new startup, any new entrant into the market. So I think that people have to realize when we talk about systemic risk, we're really talking about the concentration in existing players, and that, these emerging markets, whether it's stablecoins, whether it's, other, tokenized equities, whatever we're looking at, it's a very small percentage. It's not a systemic risk at this, at this point. Maybe maybe sometime down the road, but right now, this is not going to upend our financial system. What upends our financial system is when you have too much consolidation, you have too much of the global funds in one place, and there's a problem there. So yeah, I find it interesting when we start going down this kind of discussion of systemic risk, because that's so far from what we're talking about here, and just shouldn't even be in the conversation.
Summer, I think crypto is always slightly surprised when they hear that Congress has other matters to work on besides digital assets. And I think we're seeing a little bit of that now with the potential housing legislation that the Senate is currently probably going to be working on in February. So do you think it's possible for the Senate Banking Committee and the Senate as a whole to multitask, or are we going to be looking at crypto taking a little bit of a backseat until March, which is something that we saw reported earlier last week, and I think sent a little bit of a shockwave, some concerns through the crypto community that maybe we're not going to see this thing get done this year, this bill get done this year now at all.
Yeah, I think it's hard to remember that all these committees have other priorities as well, and that crypto is not the only thing they're working on. Agriculture is a great example. Like, they have to pass farm bills, they have to deal with farm programs. They've got forestry and nutrition titles. These are things that are critical to the U.S. economy, and so yeah, crypto is very critical to those of us in the industry, but it's not. It might not be on the same level for some of these members, a lot of these senators who maybe have joined the agriculture committee. They're looking at nutrition titles and making sure that their constituents have access to healthy food, and crypto is just part of their what they have to think about on the committee. And the same thing with banking. It's banking and housing. Housing is a very important piece of what the banking committee covers. And we all know that there's real problems in the housing market. And so they have a bipartisan bill that has a lot of support, that can get on the floor, can get off the floor, can get to the president's desk. I think what they're saying right now is, let's stop and take some time to get this crypto bill right. And in the meantime, move forward with something we know we can get done. Because I think the worst thing they could do is do nothing during this period. That's not helping anyone. So, and they can, they have different teams too. It's not the same people working on every issue. So the housing team has been working on housing the whole time. The crypto team has been working on crypto. So just because housing is going to be going next and getting the attention, that doesn't mean the crypto team has stopped working and won't be fine tuning their legislation. So it really isn't a setback. I think it's just, they need to keep moving forward. It's good. They can't wait. They can't just stop and wait. And now we have the time to get closer to a bill that works for everyone, because there's just some fine tuning that needs to happen, and this is the opportunity over the next month to do so.
Got it. Summer, thank you so much for joining us.
Yeah, anytime.
Yeah, it goes. Yeah, thank you.
Good luck with the snow.
You too. Yeah.
You too.
Bye.
All right. Well, next up, we have another stalwart in the crypto policy space, Miles Jennings. He's the general counsel and head of policy at investing giant a16Z. Miles, welcome back to the show. You were actually our lucky number 7 guest on Crypto in America last year when we launched. So welcome back.
Hopefully I did respect to the number. Thank you for having me. It's great to be here.
Yeah, it's amazing. Nothing has happened since then.
No, nothing at all.
Nothing at all. Yeah. We brought you back, so something can happen. Yeah.
For sure.
Well, Miles, you've weighed in on this public debate on crypto Twitter over section 505, of the bill on tokenized equities. I think I know what you're going to say, but just to rewind a bit, and for our audience who hasn't heard or partaken in this debate at all, do you think it gave the authority to ban tokenization, or were those fears voiced by Coinbase and some others overblown?
Yeah, I mean, I don't think that it did give authority to ban, and I think that more specifically, what people are worried about is whether or not it constrained the ability of the SEC to grant exemptive relief with respect to existing rules that apply to securities. I also don't think that it did that. There's a very specific provision in there, right, that says that that nothing constrains the SEC's authority with respect to exemptive relief. And there are several provisions in the bill that do that. So that do preserve that right. And so I think that the fears were probably unwarranted. At the same time, there were a lot of sections that were dropped into that bill, I think, that industry hadn't seen before. And so expecting people to be able to take and have conviction and views moments after kind of getting the text, I think is also difficult. And so I can understand where some of the concern was coming from. You also have to remember that the industry is kind of been in a foxhole for 5 years. So whenever, things shift, right, there's a little bit of skepticism or concern that they might be moving in a direction that is similar to what we've been dealing with for 4 years. So I think concerns are warranted in the sense of like, okay, where is this coming from? Why is it happening? But at the end of the day, I think that the language is okay. All that said, right, I do think that section 505 is just a restatement of existing law, which means I also don't think that it's necessary. And so at whether or not industry wants it out or in, I think we don't really have a strong opinion there.
Mm-hmm. And Miles, from where you sit, what would you say are the best parts of the Senate banking bill? And then also on the flip side, the worst parts?
Yeah, so I mean, I think that the best parts are that it protects developers, it helps foster decentralization, and it provides a level playing field for entrepreneurs. I think if you look at any tech industry, those are kind of protecting developers and having a level playing field for entrepreneurs is something that comes as table stakes for any tech sector. And I think people forget how important those things are to actually fostering innovation and leading to, greater development. The industry has largely had both hands tied behind its back in trying to push this technology, right? Developers couldn't talk about what they were building openly. They couldn't actually use, open networks in an open way to try and bring, consumers in. So I think at the end of the day, it's been a lot of trouble, and there've been a lot of hurdles for people being able to develop in this. And we're looking forward to a world where we have a level playing field and everyone can operate out in the open. So I think those are the best parts in my view, right? Things that just basically put this industry on the kind of the same playing field that other industries are on. I think that's going to be really important.
Yeah.
Oh, go ahead.
Go ahead. Sorry, Miles.
No, I was just going to say, in terms of the bad, I would say, like, obviously, like everyone else, we would like to see a resolution on the yield issue. I think, there were some things that needed to get cleaned up in the bill. Again, this is a product of, it's, a 272-page bill, I think, and some sections are, not entirely consistent with other sections. And so I think that raises concerns as to whether or not, there are different intents and how those ambiguities between those could be read. And so I think that what we want to see is that stuff gets sorted out. And, I think that the Senate banking staff continues to work on that. And we're very optimistic that this moves in the right direction.
Yeah, Miles, you beat me to it, but I was going to say, I imagine Andreessen has some portfolio companies who are obviously interested in how that yield debate plays out. I'm curious, where do you think we land on this? There's plenty of exceptions. Oh, it's too narrow. But like, how do you see us getting to a resolution on the stablecoin yield question? Some technical difficulties. No snow yet, but it looks like we potentially lost Miles there for a minute.
I didn't like your question, Gerald.
Yeah, it was a tough one. Stablecoin yield is tricky.
No, it's all good.
I think it sounds like maybe if we don't get Miles back, we may move on to Gabe.
I think we're just going to pause it.
We'll do it live.
Cool. All right.
Bill O'Reilly had no idea how much of a revolution he started with that statement.
I'm a big fan. We're a big fan.
We'll do it live. All right. All righty. So we are going to move on now to our third guest of the show. We have Gabe Dinari. He is the co-founder and CEO of Dinari. His firm is one of the largest providers of regulated tokenized U.S. equities with over 275 tokenized stocks, ETFs, and more across 85 plus jurisdictions. Gabe, welcome to Crypto in America Live.
Thanks for having me.
Yeah, thanks for joining.
Did we get your last name right? We were talking about it before you came on the show.
Ott is how it's pronounced. It's
yes,
German, but it comes from the German Otta, so close enough.
There we go.
Well, thank you for coming on today.
Thanks for having me.
Yeah.
So last week we were preparing for a markup, and then, as you and our listeners know, it fell through in the final hours before. From a builder's perspective, what were you hoping to see with this act?
Well, I got to see one of the later drafts of it from the Senate banking side of things, and on the tokenization side, which is obviously relevant to Dinari. I thought it was really fair in what they were trying to do, which is left room for innovation exemption through the SEC, and it protects customers, right, and investors' rights, specifically around tokenized financial instruments, which I think they distinguish between that and real-world assets. And what Dinari does in terms of tokenized stocks falls into tokenized financial instruments. And the bill clarified that just the act of tokenization doesn't change its applicability to securities laws, which we definitely agree with. And by that, I mean the same protections that exist, the same rights that exist to sort of standard shares, tokenized shares should have as well. because it doesn't make sense just because it's tokenized now. It's also all of a sudden an inferior product for the end investor. That doesn't make sense to me.
Yeah, Gabe, I want to talk more about tokenized stocks, but I have to also say we didn't get your title completely right. I believe it's Dr. Gabe Ott. Is that right? And
I wouldn't worry about that.
okay, so well, I wanted to ask,
That's
so
cool, yeah.
just the connection to Freenome and that sort of space leading you from healthcare and maybe drug discovery into Dinari, like what drew you into this space as an interesting kind of switching of gears?
I think so. It wasn't a switch so much as really an interest in this space after I was done with the other space. So with Freenome, I stepped down as CEO as the company was actually filing to go public. And honestly, I thought I wasn't really going to be an entrepreneur again. In fact, I went to seminary. I actually became a hospital chaplain, and I was kind of headed in a completely different direction for this next phase of my life. I came back into being a founder specifically because I was really frustrated actually with how some of my money was being managed and wealth management in general, and how siloed everything was. So like if you want to invest in bonds, it's a completely different platform for if you want to invest in stocks, and don't even talk about private shares or anything along those lines. And this was back in 2020. So tokenization was almost like a bad word to say at that time. But my vision for where the future was that tokenization was going to take off, and it was going to allow all these different assets to communicate with one another. My hope is one day consumers have a single platform that they can go to and be able to sort of invest in whatever and do banking all on a single platform. That would be amazing. And I know some platforms like Robinhood have been trying to approximate that, but it's a lot of work to do that manually, and there's still some limitations. So really, I came back into the space because I wanted to solve this particular problem. I was inspired, of course, by a couple of people who had made that transition before me. Balaji being one of those people. He was actually working on his women's health company called Counsel, which happened to be headquartered right next to the Freenome headquarters. So we knew each other actually as biotech contemporaries, not crypto. And he obviously made the switch to crypto first by going to Coinbase. And so I asked him a lot of questions, I think, before I sort of dove into this space. But that was actually a big push of like, I just saw a problem and I really felt that blockchain-based technology was a solution for that particular problem.
Mhm. Yeah, I know also, Gabe, that Dinari also recently announced the advancement of its tokenization efforts through a partnership with Flow Traders. Many of the leaders in tokenized equities say that we already have these rules in place for these products to exist. Do you kind of think we're missing something here, focusing on the front of tokenization language in the Clarity Act?
I think that what's not clear today is what is the nature of tokenized instruments that are inferior to the underlying stocks. So those tokenization standards, I think they're largely called wrappers, that doesn't confer dividends, that doesn't confer voting rights, that or somehow it's not the underlying legal rights to the stock and things like that. What is the value of those assets? What is the nature of those assets? Are those legal in the US and elsewhere? Like there's actually lack of clarity around that. I agree that the securities laws itself exists, but there is, I mean, not to be too pithy, but there is lack of clarity around some of these solutions around tokenized stocks and other assets that I think does need clarification.
You bring up a really interesting point on the instruments that have actually gotten out there previously, and it's what they end up looking like often is just a redemption right in like an SPV, right? So there's an issuer, they're holding the shares, they're getting all those primary rights, and this applies maybe even more so to secondaries, which I know have been a huge topic of tokenization. What do you think about the NYSE announcement at the beginning of the week and seeing a market basically change its infrastructure versus your point about these kind of typical maybe quasi tokenization stocks that we've seen in the past?
I think it's a great thing that the industry is adopting this. NASDAQ, I think, announced something similar earlier last year. Obviously, DTCC is working on it as well. And I understand to a certain extent, a lot of that is coming from they don't want to get obsolete, right? Become obsolete. And so they want to sort of stay on top on the cutting edge. But I think in general, it's a really great thing for the entire industry to get tokenized under, yes, some of the existing securities laws framework. So a lot of people, talk about tokenized stocks and, like, what's the value of it if you can't violate KYC or AML rules, and if you can't just trade them permissionlessly and things like that, then they're no different than the underlying stocks. That I think that's a really kind of a naive take, right? We have to remember that stocks and the technology behind stocks were really developed in the 80s and the 90s. And so there have been improvements over time, of course, but fundamentally, it's still limited to kind of what the technology was available back then. So that's one of the reasons why, for example, the concept of being able to swap from one ticker into another ticker, like Google to Apple or something like that directly without having to settle into fiat first, doesn't really exist. Now, if NYSE or NASDAQ all of a sudden adopt blockchain-based technologies, that can now exist in a way that doesn't harm liquidity, in a way that doesn't harm, that doesn't cause fraud to happen or whatever. And so, like, people talk about those kinds of things. But the implication of everyone adopting tokenized standards with securities laws in place is actually far more interesting, right? So one of the things that I'm particularly interested in pushing forward beyond Clarity Act, because we often just get hung up on Clarity Act as the next big thing. But let's say that everything gets clarified around tokenized stocks. All of a sudden, maybe you're able to swap in from a Google to an Apple to, whatever, Robinhood or whatever stock you want to invest in. Okay, well, what's the tax treatment around that? Because certainly, if you cash out to fiat, it's a taxable event. But if you're swapping from one ticker to another, which, by the way, 90% of people who trade stocks in the United States is really wanting to go from being in one ticker into another ticker, right? They're not, always just sort of cashing out or anything like that. And so if that's the case, and we now have a technology that's tracking every one of those trades so that we can, for each stock, trace it back to the basis point, you might not have taxable events as we, swap into different tickers. That's a fundamentally, like, really groundbreaking benefit to the end investor that would not have been possible with the existing technology. So what do I think about all these guys moving on to the tokenization standard and coming onto blockchain? I think that's a really great thing for all the end consumer ultimately.
Gabe, how does this regulatory path and the implementation of Clarity and Genius, obviously, to improve the chances of tokenized U.S. equities becoming a part of the market architecture? I mean, not just in the U.S., but also outside. It's, not something that's outside of it like it's been for so long.
Yeah, so Dinari, this is public out there, was granted the ability to tokenize stocks and offer tokenized stocks to U.S. customers. We did this with a lot of conversations with FINRA and the SEC, really get them to understand that we were not interested in breaking securities laws. We really do believe tokenization as just an improvement on the existing infrastructure, and already we're seeing sort of dividends of that action and being able to provide that for U.S. customers. I think Clarity will only sort of accelerate more and more players being able to participate in that to the benefit of the end users in America. So really excited to see, future drafts of this. I understand that, there are some delays on this, but I have conviction that this bill will pass in some form or another, because it has to, because there are things that need to be clarified, like the definition of a real world asset versus a tokenized financial instrument, like the yield issue that, obviously is part of the Clarity Act. There's just a lot of investors and interested parties are waiting for this clarity to jump into the industry. So I think this is going to be a good thing for the industry, not just tokenized financial instruments, but certainly if we really believe in the manifesto by the SEC, Project Crypto, if we really believe that's the end state or the future state that we want to get to for the entire space, I think Clarity Act is just going to accelerate that switch of traditional technology to blockchain-based technology.
Yeah, Gabe, there's a big debate right now over how permissionless protocols, sort of legacy protocols, fit into tokenized equities, given that many large financial institutions today still need like walled gardens with permission layers and viewer keys. Do you see this as a blocker to the technology that you guys are building, or do you think that these two systems can kind of coexist or integrate?
I think they can coexist. So Dinari has our limit order book that's on chain. That is a private chain. So similar to what NYSE, I think, has been talking about, is like it's going to be a private chain. Part of that is we had to do that for these KYC AML laws that exist, and we're not going to flout those laws, right? Those laws exist for a reason. Actually, we are all beneficiaries of those laws, because we enjoy the most liquid and the most trusted market that we all benefit from. But part of it was also actually just technological, in the sense that a lot of the open chains, unfortunately, the settlement times are such that they're actually pretty slow in comparison to what stock trading actually needs. So you actually need to build custom solutions to have parity with existing technologies in terms of the speed. Now, that doesn't mean that public chains are useless. In fact, they're very helpful in terms of how distribution ultimately happens, right? So when you're trading stocks, what you want to have happen fast is the price to be set on a market trade immediately, right? You don't want that waiting for the block to settle, right? But once that has happened, you want to be able to control your own destiny. And today, I don't know if you guys have ever moved brokerages, but moving from like a Schwab to a Robinhood or something along those lines is a painful experience. And by the way, oftentimes there are other things going on, like they're lending out those stocks behind the scenes to earn yield on it, similar to what we've talked about with stablecoin and fiat and all that stuff. So all these shenanigans are happening that really belong to the end user to control and determine what they want to do with it. That's where the public chains are going to come into play, is you get to see it, you get to have it in your wallet, you get to confirm that those are the actual ownership of the stock. Again, this is where the definition and the different implementations have to be clarified, because not all of them are the actual rights. But I'm talking about the end state where clarity has passed and the others are not considered real tokenized stocks. I'm talking about the real tokenized stocks coming into play. All of a sudden, you can have it in your wallet alongside your stablecoin, all that stuff. And then somebody on top of that is going to build a UI that all of a sudden allows you to do banking right next to trading of different assets for the first time, really ever, in a way that is self-custodied, in a way that you can trust that you actually own those assets. That's a really exciting thing. That can't happen on a private chain, and that has to be subject to all the securities laws. It's not that the public chains aren't subject to securities laws, but the ownership and where it lands and things along those lines is a little bit more flexible than where the trading actually happens. And so I think there is this, what we ended up doing was actually working with various chains, and we natively bridge to the public chains so that the assets end up on those chains, so that our chain is just doing the order matching across chains. It's not meant for accumulating TVL in and of its own right. It's just allowing for the flexibility, for the speed of the order matching, plus the flexibility of owning it wherever you want to own it.
Okay, before we wrap things up, I got to ask one more question to you is when you think about the future of all of this, what will it truly enable if US capital markets were expanded and accessible on a global scale? And how are you already seeing this play out?
So Dinari launched its product in 2023. And for the first couple of years, we really predominantly existed in ex-US markets, bringing tokenized US stock to various regions around the world. And what I can say is the appetite there is insatiable. And so the exciting thing about tokenized stocks, I think, in the end goal that you described, is as global access happens, it's going to be more liquidity and more trades that can happen across different tickers. So like today, US investors really don't have access to certain things like Saudi Aramco, for example, which is a stock that many people want to own. So it's actually bidirectional, right? It's not a global tokenized stock standard and marketplace enables us to own interesting assets from around the world, for people around the world to own interesting assets from the United States in a way that is just as trusted, just as protected as the NASDAQ and NYSE have become in the last 90 years or so. And I think that's really the end goal of being able to invest in all these interesting assets alongside where you're banking in whatever app you're already used to using, right? So it's not like you have to all go to Schwab, because I think I heard earlier, on the podcast, like centralization of so much liquidity and things like that to a few companies is dangerous. I agree with that. I think that people are already around the world using the apps that they're comfortable with. I think it's about enabling access to these assets in those apps or wherever people are already used to using. And people should be able to just get to choose which platform they use to trade instead of being forced to open up like 5 different accounts in 5 different places because you have, you want to trade a certain asset. So like really my dream is not just that there's one platform where you can trade everything, but every platform essentially becomes a place where you can trade everything so that the consumer can ultimately choose the user experience that they want the most.
Yeah, I mean, that would be great for sure.
Exciting times. Yeah.
Yeah. Awesome. Well, Gabe, thank you so much for coming on today, and keep us posted on your side.
Thank you so much.
Thanks, Gabe.
Thanks.
All right,
team.
Fun show, fun Friday.
Yeah.
Doing it live.
We'll get
doing it live. We'll get Miles back on.
Yeah,
right.
we'll get Miles back on next week.
All right. Awesome. Well,
Cool.
have a good weekend, everyone, and thanks for tuning in.
Thanks,
All right.
everybody.
See you next week.